Hello, everybody, and welcome to this week's edition of our Online Investor Insights. I'm Bonnie Halper. I write the weekly Startup One Stop newsletter, and I'll put the link in the chat. I also work with founders on their pitch decks and talking points, and even ghostwriting, because you guys don't know how to do a pitch deck properly, right, Dipen? He'll tell us later. No, it's true. Nobody gets it right. So I want to thank Joseph for hosting us. Joseph, tell us about you.
Thank you, Bonnie. Good morning, everyone. Great to have you all here. Name is Joseph Katz. I'm a startup marketing guy. I've seen the good, the bad, and the ugly in the startup space. Worked with and for about 10 different startups, some exits, some failures. So I've seen what works and what doesn't, and help companies put go-to-market strategy, customer acquisition plans in place so that they can grow. I'll put my contact info in the chat. I suggest everyone do the same throughout the call, and looking forward to a great conversation.
Well, I also forgot to mention that once I help you get your decks right, and decks we know that are constant, they're a work in progress at all times. I make introductions to investors or strategic partners where and when appropriate. So Dipen is our guest investor this week, but he wants to go around the room and have all the attendees introduce themselves. So Eric, take it away.
Thank you, Bonnie. Eric Becker, I'm the founder and CEO at Millimatch. And Millimatch has created and we're commercializing an organizational intelligence system that focuses on execution risk. And we are addressing it from the people side by measuring behavior over time.
Thank you. So Mary Scott, tell us about you.
Hi, I'm Mary Scott. I work with startups in St. Louis, and I run an organization called Pitch STL, which is a way to have startups learn how to pitch, whether to customers or investors. And I have a podcast, so I'm always looking to talk to investors about what they're looking for so that startups know what ducks to have in a row before they bother you guys.
That's right. Useful service. Ian, always good to see you, and tell us about you. Ian?
Can't hear you, Ian.
We don't.
Yeah. Oh, it's something. You're not muted, but something's wrong with the sound.
Yep.
Oh,
Can't hear you, Ian.
can't hear you. We'll come back to you while you get that sorted out. Sam, take it away.
Hi. So I'm Sam Bogosh, co-founder of Axle AI, and we do AI for video in the sense of searching and tagging large amounts of content. We have 18 people, and we are recently cash flow positive. So excited about that.
Good for you. That's always a nice place to be in. Anybody going for investment certainly knows that that's catnip to investors. Carrie Fox, take it away.
Hi, I'm Kerry Fox. I'm a executive producer and writer for intellectual properties, with the idea being leveraging them into the entertainment space. I'm currently raising pre-seed for my musical theater experience called David Bowie Loves New York, which we're looking to launch toward the end of the year. I also have other IP dealing with Sam Bankman-Fried, Martha Stewart, Robert Frank, others, and looking to stir the pot a little bit.
Pick some interesting characters. Tino.
Hello, hey, I'm the founder and CEO of Baru. We're a tech-enabled manufacturing marketplace. We sell custom cabinets for your dream kitchen at half price, delivered 4 times faster. I'll put more details in the chat. Thanks.
Okay, thank
we're
you.
Also raising angel round.
Carson.
I'm Carson Rast. I'm the founder and CEO of Versa Materials Technology. We're a battery material startup aiming to bring low-cost, future-proof cathode material processing to the U.S.
Oh, thank you. Ian fixed it. How's his audio fixed?
Yeah, I think we're okay. Can you hear me?
Yes.
Okay, Ian Garmaze. I'm based in Toronto, but I work for a Los Angeles consulting firm called Virtual Film School, and we help growing firms with their social video and social media strategies.
Ah, thank you. Lon Taylor.
Hey, good morning, everybody. My name is Lon Taylor. I run a market research and UX research company called First Insights. I also mentor for Florida Atlantic University's Tech Runway program. And out of the three companies that I've been mentoring over the past year, one just exited and sold themselves for 7 figures, which is very exciting. So I guess my advice helps a little. But great to meet everybody, and Bonnie and I have known each other for many years.
Many years. And congratulations on the exit. I hope you had some skin in the game.
I did not, but it's fun. It's fun to see a guy who had super energy. I think he picked the had the right product for the right time.
Yeah. Sarah, welcome back.
Hello, great to be back. I'm based in Zurich, Switzerland, and I have banking background, and I work in the finance area, banking, and also focus on strategic partnerships and business development in sometimes select areas like real estate and e-commerce as well.
Ah, thank you. So Dipen, take it away. How does it feel to be back in the funding side or on the funding side?
Well, it's an interesting space. So just to give you a little bit of background on me, my name is Dipen Jobanputra. I studied law and Japanese at university, but decided not to become a lawyer, and didn't end up living in Japan, which is a bit of a regret of mine because I did enjoy living and studying there previously. I moved into banking at Goldman Sachs, and had an amazing time there. But my head got turned very quickly, and I went over to join Dresdner Kleinwort, which was a German British bank, so the worst of both worlds in terms of execution. And one of their great years was when they only made a $2 billion loss, and I was there thinking, what have I done? But I learned a hell of a lot because I was in a very industrious space called digital markets, led by one of the thought leaders in the digital and e-commerce space, a guy called Sean Park. He was an early investor into companies like IHS Markets, which is now S&P Global, and that's had obviously an amazing ride. And Sean, if you look him up, Sean Park, and you look up the Park paradigm, you'll see one of the visionaries within the fintech space, a truly decent human being who actually knew what was happening and was berating us all in 2006 to buy Apple and Amazon, which we were all hesitant to do. And I think he's done very well personally. I then went over to Jefferies, where I worked in the fintech space, working in the algorithmic trading division, in sales and business development. And I spent 14 years there, working for an unknown bank called Jefferies, as it was then, which then has become essentially a bulge bracket competitor. By the time I left in 2020, that journey then led me onto blockchain.com, where I worked in the digital asset space, now as a more seasoned and senior individual, working with the senior leadership team and looking at institutional relationships. But we all know what happened with crypto in 2022
Yes.
and 2023. And so I left and then became a founder working on my own startup. And to provide context, while I was at Jefferies, although I was doing 14-hour days on the trading floor, looking after clients trading, I still found myself with a lot of free time, strangely enough. And so I started selling theatre tickets to a lot of my colleagues. And that grew and grew and grew. And ultimately, I created my side hustle, Second Degree, which is now a closed membership club. So it's referral only to about 450 high net worths, and people of note generally, although I'm on it. And I organized their trips to the theatre. That not being enough for me, I decided to get into the theatre ecosystem. And so I now have invested in about 50 plus West End theatre productions, a number of which have gone on to the US and won Tony Awards, as well as Olivier Awards over here. So I knew and understood the theatre space, and the biggest problem I could see was ticketing, because why would someone who's quite an educated individual want to buy their tickets from me? It didn't make any sense, but the whole ticketing process was broken. And so my idea was to put theatre tickets onto a blockchain, effectively creating NFTs, getting rid of scalpers, and passing the rewards that could be obtained for a hot show and secondary ticket sales back to the risk taker, me, the investor, who has invested alongside the producers. Unfortunately, although we raised relatively quickly, we raised about $1.25 million in 10 days in soft commitments, not hard commits. But we knew that we were going to get at least 50% of that. What we found when we were doing more diligence was that there was an issue around product market fit and the customers that we were going to go to. We only needed 5 customers, but we knew there was a product issue with them and a mismatch culturally with what we were trying to do, which is move a paper-based system onto blockchain and into the future. And the theatre business, in some respects, can be quite old-fashioned and archaic. Also can be run on ego, so you can't necessarily get 2 people to work together. Whereas when I was at Goldman Sachs and then later at Dresdner, we could get Morgan Stanley, Goldman Sachs, Dresdner, Jefferies to work on the same electronic trading platforms and through the same APIs because they understood it was for everyone's mutual benefit. But that wasn't an argument that really worked with the theatre business. So seeing that there was an issue around PMF, seeing that we had a less than 24% chance of success, we decided not to take the investor money because that would not have been the right thing to do. And we graciously bowed out after 10 months of blood, sweat, and tears, trying to build our startup, trying to get people to understand what we were trying to do. And then I was pitched by the team here at Velocity Capital, who wanted me to invest in them because alongside my theatre investments, I've been making angel investments into fintechs, none of which has come good. We have a scheme here in the UK, which if it was in the US, would work one of 2 ways. Either it would be admonished for being socialist, or it would set the US startup system on fire. We have a system here in the UK called EIS, which is government backed. It's through the government. And if you go into an EIS qualifying company, the following tax year, once the shares have been issued to you, you get 30% of your investment back in your taxes. Your investment is free of capital gains.
Wow.
Your investment is free of inheritance tax. And if the company goes to zero, then you get a certain amount of your money back through your taxes. So in some cases, you are risking 21 pence in the pound. I just can only imagine what would happen if this was available in the US.
I wish it was. I know that there are some places where you get 30% tax credits for
If you
being
have made a capital gain by selling a property, you can roll that money into an EIS investment or an EIS fund. And now your capital gains tax liability on that capital gain is deferred. And so you can just roll that money again and again and again and again, and potentially never have to pay any capital gains tax on an investment that wasn't EIS. And we also have a scheme called SEIS, where instead of getting 30% back on your money, because it's a smaller company, earlier stage, you get 50% of your money back. So your risk is significantly lower. That's where you get down to the 21p in the pound. So the people that pitched me, the problem with EIS is it often sounds for, excuse my language here, every investment is shit. Because when you're usually shown an EIS investment or an early stage tech investment, it's of a friend who knows someone, and this is going to be the next Nvidia or Amazon. And invariably, as I've done before, you put money in and it's then the actual tax break that you're looking for as opposed to the upside. So when the team at Velocity pitched me, I politely declined, but I still had a chat with them because I really liked the team. And they gave me an example of one of their investments. And this was to create a marketplace for SMEs where they could find loans, grants, and funding. It's called Swoop Funding. And I thought, oh, that already exists for the retail customer, but I didn't realize it didn't exist for SMEs. But as with startup funding, you're investing in the idea, but you're really looking at the execution capabilities of the founder. And in this case, the founder was a woman, and only 2% in the UK, only 2% of investment funding goes to women. So I thought that's a bit different.
Same here too, by the way. It's 2.1%.
So I'll come on to that funding gap, which I think is very important to address, because in this instance, Andrea, the founder, was a partner at KPMG. That's great. If you look into her history a bit more, she was the daughter of the Prime Minister of Ireland. So, you know, phenomenal network effect there. And she sits on the board of a company called Berkshire Hathaway. I mean, why was I never getting shown deals like that before, right? We've got another investment company here called Sportlight, which uses LiDAR technology to look at what your athlete is doing on the football pitch. And so when that was being explained to me, okay, it's hardware, does it really fit with our thesis of tech and VC, tech and consumer, but we can see the consumerish angle to it because you've got to go out and find customers. But when they showed me the cap table, it had a gentleman called Henrik Kraft on it. And I know that name because he was a significant senior principal at KKR. And he also owns a football club, a Premier League football club here in the UK. And this technology is being used by football clubs. And so when I started being shown the deals that they were working on, I realized that as an individual investor, individually sourcing, I wasn't going to get anything good. But now, because I'm going through a fund structure with a team that have made angel investments, done pretty well on the back of their angel investments, set up their fund, taken a few punches to the face, on the back of that have crystallized what is a relatively good thesis that works for them where they can help. That suddenly started to make a lot more sense to me and to a number of my friends who have been all battle scarred through angel investing because nothing's come good, to now actually going into companies which make a lot more sense versus the friend of the friend who's trying to help out a buddy but hasn't actually done the diligence. And I went back to my own background as a founder, which was, sorry, it's a bit painful to talk about because last night we were at Goldman's private banking. They were hosting us and a few of our founders, and it was a bit of a get to know you from what Goldman's does on the private wealth side, but also what they can do with the team at EY in terms of tax advice for founders and how they look at Series B funding. And I was there thinking, I should really be at this table as a founder, but I'm here as the VC. And it does hurt not being the founder again, but it's very important that you understand, number one, that you're the right people to do the job. And number two, you've got product market fit. And with us, we knew we were the right people to do the job, but we also then worked out we didn't have the right product fit. And we were able to work that out because we'd gone to a number of people in my network in the PE and in VC space, and we'd given them our deck, talked through our business idea with them, which they really loved. But we then said, come and be don't hold your punches, punch us in the face. So by the time we'd got through a few iterations of the pitch deck and really synthesized the idea, we were able to really go out and entice investors in. And they really loved, number one, the passion that I had, and they really loved my experience in that theatre world. But then my co-founder, who I'd known for 19 years, who used to be my boss, who was Cambridge, PwC, Goldman Sachs, chartered accountant, CFO, COO, and holding this guy back to make sure he just stays on target. You know, we've all seen Star Wars, stay on target, stay on target, stay on target, and keeping me laser focused, which I knew was my weakness. But sorry, I digressed a little bit there. But once you've got those materials together, then I think you can really move forward as an individual with your startup. And that's when you become somewhat backable. And we realized that we weren't going to be backable. I'll just pause there for a second if there are any questions or any comments you'd like to make, Bonnie.
You know, I just wanted to comment, since I said quite a few investors showed up at our investor breakfast, you know, and angels. And a number of them told me that they're switching to become LPs in larger funds because so I feel your pain. They're experiencing the same thing.
I think it's a smart move to go towards that because at least you've got the GP looking after you. The problem is a lot of people don't have the capital and the firepower to put down a real ticket to become an LP. And an LP in a fund, I mean, the EIS structure is very, very different here in the UK. It would be more like a Series A advanced angel fund in the way that we're structured. So our minimum ticket size is 10,000 sterling. Yeah. And we then also show what we're delivering into. So the majority of other funds that are out there. And when I talk about our fund, I don't want to be too shilly, but the reason why I liked them was they weren't bankers. They were operators in the marketing communication space. So my boss and CEO, Raj, one of the founders, he was employee number 3 at Red Bull UK. and he obviously did a lot of their, he was head of marketing, so he did a lot of that guerrilla marketing, but he's invested in multiple different types of business. So he is an entrepreneur. And so when they were constructing the fund, they looked at the problems that funds actually provide to their investors in terms of barriers to entry. So he decreased the ticket size. The annual management charge is applied from year number 3 and is on the notional invested, not on the net asset value, where funds can play a lot of games.
Yeah.
And get themselves into trouble. And then going for businesses that where we thought we actually genuinely had a shot of helping them, but because we're so skewed to the outcome, because our fee structure is so investor friendly, we have to really hustle with our portfolio companies to help them out. Whereas when you're going into a traditional GPLP structure, they're just larger, and so they've got a bit more time to breathe. I wouldn't say cruise, but they've got a bit more time to breathe because they've got know that they've got that fee income coming in, and it's a bit more controlled in terms of the investor doesn't necessarily, it depends upon the fund structure, but you don't necessarily have the optionality to say, I'm going into this investment, I'm not going into that investment. I'm not sure how it works in the US.
I don't think they know either. Any questions?
Yeah, I have a quick question. Dipen, are you familiar with this US scheme called QSBS?
I knew somebody was going to bring up.
I've seen a lot of it on LinkedIn, but I don't understand it. But it's where founders can potentially get out with a zero tax liability or a de minimis tax liability, correct?
Federal.
Right, and apparently I just did a little research. It's got some similarities to SIS, you know.
So
And
the EIS
You got to bring Joe
scheme-
back for that conversation, Ian.
Yeah, we have to do an introduction. Go ahead, Eric, take it away. To
Sure.
Joe Milam, who's all over that.
yes,
And
Joe Milam is
yeah,
the expert on that topic, and boy, he knows it. And it does seem, from what I read briefly, it does seem to have some interesting similarities, both introduced around the same time in the 90s.
And I think in the US, you have a culture of success.
Okay.
In the UK, we were discussing this last night with a couple of our founders, a company called Journey, actually. And what they do is you book a holiday with them, but you don't know where you're going. And in the run up to the holiday, they send you a packing list, ideas on the weather and whatnot. And then you turn up at the airport, and then you're actually told, right, this is your destination, this is where you're going, here's your itinerary. Which I thought was a crazy idea to invest in April 2020 as a travel company. But it's a phenomenal business, phenomenal founders, and you can just see that they're really moving forward on that. But we were discussing this, that the US really does, for a variety of reasons, has an investment culture and a success culture. And I often found that when I would tell people that I was in sales, if they were British, they'd be like, oh, that's a dirty job, isn't it? Whereas if you tell someone in the US you're in sales, you're the tip of the sword.
Yeah.
And the view was, oh, so you know how to hustle, you know how to communicate with people, you know what you're doing, you understand your product. But in the UK, only recently has sales business development been viewed as that avenue of you do actually know what you're doing. It's been viewed with a little bit more respect, and people realize that you can actually make a lot of money if you're relatively good in sales.
and you need sales. You know, we have a late arrival. Henrik, do you want to introduce yourself briefly?
Yes, can you hear me? Yes, it's
Yes.
Henrik Leborg. Good. Yes, good morning, Henrik Leborg. I'm a fractional CFO based in Toronto, Canada. So I help startups, scale-ups, generally technology, but also business services, grow their business. They are generally 1 to 10 million in sales, 5 to 10 employees. So I help them with their financial management as they're scaling. Thank you.
Thank you. And put your contact information in the chat.
Yeah, I will do that right now.
Okay, Dipen, take it away. Or any questions?
Well, if nobody else has one, I have a question.
I know you. Please go ahead.
Well, it was right. What you talked about right at the outset about your ticketing startup. You mentioned, oh, we don't have product market fit, but how did you determine that in a kind of a definitive way?
So I was very fortunate. I spent 20 years in financial services. So I built up, and I was in sales. So I built up quite a network. And I was able to go to a number of senior people within the investment space. So I'd not worked in investments, I'd always worked on the other side. But I was able to go to 3, 4 relatively successful hedge fund managers and say, would you invest in me given the information that you've got? And it was a two-pronged question. Would you invest in me? Tick. They've known me for 10 years. They trust me. So yeah, we'll write you a 50K ticket. That's not a problem. Would you invest in the business given the data and the evidence that I've got? And that was key for me. What is the data and the evidence that I need to provide to you to show you this is a business worth investing in versus just investing in me? And that's a very different position to a lot of other founders. It's a very privileged position that I had. And through that, it was a case of, right, you know the industry, you know what you want to do, you know what the problems are, you know you're the right person to fix it. Will your customers accept this proposition? Because you're not going B2C, you're going B2B2C. And that B2B is only a small marketplace of 5 large institutions. What are the problems that you're going to face there? And we talked to one individual who was like, this is almost too ready to be a unicorn. And it almost sounds too good to be true with what you're doing. You're turning around to the end customers. You're going to give them equity in the top co for giving you a commercial agreement. But you're then going to move this to another vertical, and that vertical is going to make you a load of money. So the dividends that you're going to pay out are going to be potentially more than the initial theatre companies who've got a shareholding with you are actually going to be paying you for their service. So it almost becomes like a matter creation machine, which can't exist because they're going to pay you $100,000 a year, but you're going to pay them 120 in dividends. Do they understand that? Are you sure this is going to work? Because it almost seems too good to be true. And once we realized that, we really started talking to the potential customers that had given us the initial nod, and then found out about the internal politics that they were facing, the ego issues that we were likely to face, and then some bad practices within the industry, which would have been very hard red lines for me, which I was not willing to cross or try and resolve. And I don't want to go too deeply into them, but having worked in a regulated environment, if I was doing that in my regulated environment, I'd be in jail. And we just thought, this is something that we can't fix and solve. Plus, we were dealing with people that were from the artistic industry, not from the financial services industry, where our initial experience lay. And usually when you say to a finance person, X plus Y equals Z, they get it. When you're talking to someone in the arts world, it's not that they're financially illiterate, but their motivations are to create art, not necessarily to create money.
Right.
We had not thought of that. So we did that deep analysis, because at some point in time, I might want to do something again, and I'll need to knock on those investors' doors to say, I acted with integrity last time. I've done my homework. This is something I'm looking to do. Will you back me?
So it's a question of maintaining credibility with these investors, I guess. They see how you analyze things.
And answering investors' questions before they ask them. So we also, in the run-up to the startup, we did an analysis from the data that we could find, and we also pinched some stuff from VCs out there. But we looked at an ecosystem of startup companies, and then we looked at the data as to why they failed. So we thought, if we know why these companies are failing, maybe we can fill those gaps. A big reason for companies failing at startup level is founder fallout. So I knew that MJ and I were good friends. We'd worked together in the past. We knew what our equity structure was going to be, and it was very clearly mapped out. We were both 50-50, irrespective of who had the idea and how it was going to work out. We had very hard conversations personally in the past, but we're always able to manage them from a data and evidential perspective. And that became very apparent when we talked to investors, that, okay, you know what the demarcations are, but you get on well and you can have hard conversations. Plus, one of you has got the other one's back. So partway through our startup process, my father passed, and I was out of commission for a period of time. But MJ was able to pick up the slack and actually explain to investors and suppliers and whatnot what was going on, why I was out of commission, because, for a couple of weeks I had to sort out my family. And so because we'd been through that, we knew that would work. The other reason why we saw companies failing was bad product market fit. And that's why we really needed to nail, do we really understand the PMF? Have we talked to your mum thinks you're the best looking kid in the school. So you can't just ask your mum her opinion. We went out and asked people that maybe didn't like us, maybe didn't have an amazing opinion of us, what their opinions were on the product market fit. And that's something sitting on the other side of the table when I see pitch decks coming in. I'm like, guys, I'm not a deep tech VC, or I'm not a health sciences VC. And that for me then makes the founder look like an idiot. Have you actually read this? Some founders are incredibly pushy. I think when someone gives you a no, it's reasonable to ask why if you need more information, but to then turn around to the investor and say, you really don't understand what I'm trying to do, that's not my fault, that's yours. If you haven't conveyed your messaging to me within the first 30 seconds,
Right.
and you can't tell me what your business does in 30 seconds, because that's my attention span. We live in the world of TikTok now. Then it doesn't make sense. And I don't like using buzzwords, but I was talking to I do a lot of founder coaching, and I was talking to a founder the other day, and he gave me a long spiel about how he's got an AI and machine learning that looks at esports videos and how clever they, what looks for the peaks and this, that, and the other. And we have a show here in the UK called Match of the Day, which reviews all the UK football matches that took place on a Saturday or a Sunday, but condenses them down. So my view is, so you've got Match of the Day for esports. And so, I'm going to be doing a bit of work with this guy because I think he's got something. But the view was, look, I don't have 25 minutes to listen to you and your personal history. I'm not interested. Right? I just do not have the attention span to do that. Plus, I've got a day job to do. My day job is to find companies that are going to be a success. But at this stage, it's about the founder, as much as it is about the business idea and the product market fit. So we're not looking at the rule of 40 or the rule of X. We're looking at who is going to be the person that's going to get to that escape velocity so that we can get to that $1 million of revenue, which is what our base is, and then get you to that $10 million of revenue. And that is as much about the pounding team as it is about PMF.
That's a great explanation. Thank you.
Yes.
Sorry, a very long-winded explanation.
Oh, very lot of interesting detail on that one. So thanks.
Like I said, I work with founders on their pitch decks, and they have to tell everything. I said, investors spend maximum 3 minutes. Even Katie, when she was addressing the crowd in person, 3 minutes, 30 seconds is really more like it. Dave, what's his name? Dave McClure said 7 seconds. Yeah,
Right.
grab him.
I got a pitch deck this morning, which is 37 pages. They must have spent a fortune on it. Every fourth page is a picture of the founder looking serious. And I just scrolled through it, just thought, idiot. I don't even know what the problem is. I don't know what your company does. There's so many buzzwords, plain English, black text on a white background, just make it idiot proof for me. And, explain it to me like I'm a 5-year-old. And the key thing is, how does this make money?
Yep.
So every time I was at Jefferies, we'd get interns coming in, and I would always say to them, there's one question. There's one important question. What is that important question when you're going around reviewing all the businesses where you're going to be located? And the one guy that got it instantly set up a business called Shop Circle, which is valued at over $100 million now. His name's Luca Cartacini. And he said, the only thing I want to learn is how does each of these business units make money? And again, yeah, I'm sure that in the US, that's not a dirty question, but in the UK, sometimes that can be seen as a dirty question. Whereas when you're in the investment space or you're in the business space, how does it make money? Buy low, sell high. When I was trading, that was all it came down to. I didn't care about your algorithms or your machine learning or this, that, or the other. Those were tools to do the execution. But what were you going to buy at a low price and how are you going to sell it at a high price? And when was that time going to happen?
Okay, a quick comment on that. So I think a lot of companies forget why they're actually in business.
Yep.
They're just they're all excited about it, but they forget why they're doing it. So I have a quick question. I mean, you have a lot of experience and a lot of different sides of the business. You gave some advice, Bonnie's given some advice. Every startup founder hears lots of advice. What's the most common piece of terrible advice you've heard founders getting?
Oh, there's so many. I think sometimes founders And I think advisors in the startup space can be very good, but there are a lot of charlatans out there. There are a lot of people that just don't know what they're talking about or have good intentions. But what you really need are serious people around you. And some going to the wrong person for advice, I think precipitates getting bad advice. So let's not think about the bad advice. Let's think about going to the right people and asking them to be honest with you. And sorry, I don't mean to, there's no one from Gen Z in the room, is there?
What's wrong with Gen Z?
What's right with Gen Z? Gen Z are just so focused around toxic conversations and mental health, and you can't say this and you can't say that. Sometimes you need someone to just talk very straight towards you. Whether I like President Trump or not is irrelevant. He is a very straight talking individual that's managed to mass communicate a message to a very large number of people, and it's resonated. And I think we have to learn from that, which is just be very, very straight talking. So in terms of terrible advice people have received, get loads of people on your cap table. Why would you want to do that? Give away equity in for services. Why would you want to do that? You need to keep your cap table clean. And if you're valuing someone's services, pay them for it. So those are the short answer to your question. Those are the two worst things I've seen.
I have a quick IP question. When it comes to entertainment-based IP, what kind of IP, like in that world, gets you to wag your tail, and why?
Well, I've stopped investing in theatre because it just doesn't make any money. Unless I see something that is going to be a slam dunk. But the West End is such a fickle mistress. The only thing that will make money is Judi Dench sitting on the toilet reading the phone book. But we're not going to get her to do that again. I think the bigger problem with IP is now with AI, and theatre and live entertainment are somewhat insulated. But the way that IP is being manipulated and stolen and reused again, I think that's going to be a bigger problem for movies in the medium to longer term. But to answer your question, what gets me interested, I will always look at something in the theatrical space coming through, but costs have become crazy, and I can't understand how anything on Broadway makes money. In the West, some items can make money, but having done 50+ investments, I'm just a bit tired of it. In all honesty, I don't think there's going to be anything that's going to come across my table that was going to say this is going to really make money. I can tell you the best investment I've made, which is an Agatha Christie play called Witness for the Prosecution, which was scheduled to run for 12 weeks. It's now in its 7th year.
Wow.
Producer Eleanor Lloyd is fantastic. She just knows what she's doing, and she's lovely with me as an investor, ruthless when it comes to the production, and regularly changes the cast. No star names. The star is Agatha Christie, and it's set in a courthouse, and it's a courtroom drama.
Right.
So that's the kind of thing, if that were to come up again, that would be very interesting to me.
Right. Well, understood. These are good milestones to look at.
Sorry, Mary, you got your hand up?
Yeah, I was going to comment on your assessment of what mistakes founders make. One of the things we always try to do is get people in one sentence to say, I help these people solve this problem specifically so they can. And then why you're uniquely qualified to do that. We also get founders to really go out and talk to potential customers with 2 questions. Do you think this is a good idea? How much are you willing to pay for it? Just before you even get into the weeds of, I have to create a website and I'm all full of secret sauce. So yeah, those are the kinds of things. And I love it when people come on my podcast and reinforce that stuff.
I think everyone needs to know this, especially the new generation of founders that are coming up. I'm more interested, if I'm looking at a fintech, in a 50-year-old founder who's lived a problem and thought, I really hate doing this input work or matching up these invoices or this, whatever it is, and has seen that problem and has then chosen to fix it and find a solution to fix it, probably now in the world of AI some form of machine learning solution that decreases the time frame to get that problem going. But when I meet a younger entrepreneur, and this is not all of them because there are some amazing young entrepreneurs out there, but I'm seeing more and more people whose view is, I want to be a founder. Well, what's the problem you're fixing? Exactly as you said. And what kind of problem is it? We use the analogy of the migraine and the headache. If you've got a migraine, you take 2 Advil and get back to work. If you've got a headache, you take 2 Advil and get back to work. If you've got a migraine, you need to lie down in a room. Is this a migraine problem? And it's about those problems, and that is then going to be reflected in what people will be willing to pay for that.
That's a
Eric,
good one.
you got your hand up?
Yeah, thank you. Let me lower it here. So I have a question, and matter of fact, Mary, and what everybody's talking about, this one is number 6 for me in startup. And so I can tell you honestly, I've made more mistakes than right choices, but you learn from each one. But my question to you is, and it's a little pet peeve of mine, how do you evaluate leadership teams when you're looking at them? It's a loaded question, I know. So
it's a really difficult one. So yesterday, my boss Raj came back and he was uber excited about a founder that he's met, and his view was, and we were supposed to meet her as well, but we didn't get to meet her because he'd gone over to meet her, and the reason was that she was pregnant and he didn't want her to traipse across London. Now, for most VCs, that's already a no. That's like, woman, no, I'm not going to meet her. And she's pregnant, I'm not going to meet her. But Raj's view is, because he just comes from a different world, not banking, comes from marketing. He's seen a lot of female leaders there, and a lot of them will have had children. So instantly, those 2 initial BS objections are gone. And then he's gone to meet this individual who really knows their market, is very passionate about the problem they're solving. But it's not just the passion. It's also, right, now we've got a solution and we are the right people to execute it. And we've now shown why we can execute it. Sometimes I think founders think it's about the passion. And I was very passionate about my ticketing startup. But I'm also really passionate about making money. I used to work at Goldman Sachs. So, if it can't make money, it's a charity gig, right? It's a side hustle. And you're don't have serious conversations with people about that unless it's a philanthropist that you're talking to. So I would say it's a real problem, a level of passion around solving that problem, and then execution capability. And then obviously you're then looking at whether or not this person has done their homework and can show a good quality TAM.
Yeah.
This and then
Bonnie knows what Millimatch is all about. But what I find interesting is that a lot of VCs, leaders, they're judging that leadership team. Can they get to the next phase? Not the phase after that and the phase after that, which is, difficult. So
it's a mismatch, but I have a fiduciary duty as a custodian of my investors' money to ensure that I meet my fund's objectives. And that is a 3x return.
Mm-hmm.
Would I want to get a 30x return? Would I do want to see that company go from 3 million to $1 billion in valuation? I'd love to see that. That is not my job. My job is to take that initial pot of money that I've got and get it to at least 3x.
Yeah, the most difficult. I'm sorry.
No, you.
Well, I have a lot of VCs, not a lot, but a handful of VCs as clients that are using it. And what they find the hardest thing is, particularly in evaluating teams, it's subjective, but what are they going to be like post-funding? Some founders are great at raising money or at executing teams and vice versa. So it's an interesting dynamic.
It is, and I think sometimes that's where being a little bit older and having a few gray hairs is quite good. Having a good set of people around you. I'm not talking just about the advisory board or whatnot, but knowing you're we're all in echo chambers, knowing that someone's in a good echo chamber And when I was doing my startup, that was really important to me to not do it by myself and keep all the money for myself. I knew what my failings were. I know I get easily distracted, and I know that I'm not as good on the detail as a lot of other people are. So bringing in that expert. And then also, yeah, are you going to put, you know, half a kilo of cocaine up your nose as soon as the money comes through? It happens, right? You have to look at the individual and think, what are they going to do? So we've got two members from our portfolio companies in the office now. Ronald left school at 14, but he's a computer prodigy and has got this amazing personalization tool for videos. And yeah, they were out partying with the rest of the business development team last night until 5 a.m, but he was in the office at 7 because he's got a job to do. And he was clean and he was presentable and fully functional. And you know, was he really partying? I think he was just drinking on soft drinks all night because he's got a very important meeting and deal that he needs to close today. I think it's very difficult to know what someone is going to be like. And just look at the divorce rate within society.
Yeah.
We think we're the perfect person. We're not. And investing in a startup, being a co-founder, is in many respects like a marriage. You've got to take a really big punt. And if it's a 50% plus one chance of success, I would say go for it.
Thank you so much for that insight. I appreciate it.
So you said earlier that velocity is still sort of a work in progress. You're still formulating the it seems to me the overall thesis, and it seems like everybody in the fund has been on both sides of the table. So what if you notice that's different, and what do you where's your focus different?
So
I hear some of it when in your delivery, but curious.
Let me share my screen if I can.
Sure.
Oh, it's not. I'll send you the request, and I'll just give you an idea of what velocity is. And I wouldn't say that we're an answer to a lot of problems out there, but we're a good. It's a good VC, and I joined them because I like them.
Are you able to share it? Just making sure.
I'm just trying to find it. It's not coming up on my screen. Sorry.
It's okay. We deactivated sharing a while ago because of
Okay, no worries.
some issues. But you should have access, so let me know if it's not working.
Let me just, sorry, I need to just change one of my settings on my side. Yep, I've done that. Sorry.
Because I hear a lot of people say, "Oh, the VC model is broken," and I'm just wondering what your focus is. Go ahead.
I think the VC model is in pain.
Okay.
Can you see that?
No. Oh, there we go.
There it
Oh,
goes.
there we go.
It's good.
So this is part of our pitch deck. So I'm not going to puke the deck at you guys because I hate it when people do that to me. The guys, when they started off, were marketers. Raj was head of marketing for Red Bull. Bill had set up his own ad agency, which he sold to Samsung. And Alex is a senior advisor to PepsiCo and was an EVP at Omnicom. And so they weren't investment bankers. And their view was, well, we want to get in there with these companies because they'd learned through their own investing that you can make a lot of money. So you can see from the bottom line here, Purple Bricks, which is an online estate agency. Bill invested in that instead of taking 150 grand fee to do their marketing for them and got out at 57x. And with their own investments, they've done pretty well in terms of how much money and wealth they've been able to create. And then on the back of that, they then created the EIS fund because they realized that the EIS system is not great. Is the VC model broken? I think it is in some respects. I think it's in a world of pain because money's not free anymore.
Right.
It means you've got to get money from somewhere. In the UK, we have EIS, which makes the retail investor, the high net worth investor, more inclined to want to invest because there's a tax break for them and the revenue's got their back to a certain degree. But how do you find the right companies? And within our space of tech, consumer, digital customer acquisition, I think there's a cap in how much we should be raising every year. And I think that's probably about $15 to $20 million, which is not a lot of money. But there are certain other funds out there with bigger names and a lot more firepower that can actually raise a lot more money. But sometimes having too much money is a much, much bigger problem. And in terms of what we are doing, we've been running for 10 years. Over the last 4 to 5 years, the thesis has got better. So Swoop, which is Andrea's business, that's done quite well. And some of the other businesses we've got out at because we felt that it was the right time to get out of them. But we also realized that just being an EIS VC is not going to be enough. And that's why what we're also doing is restructuring the business so that we've got our EIS business. We're going to be looking at something called British Business Bank, which if your thesis fits, then a UK government entity called the British Business Bank will cornerstone your fund. And so we're going to be looking at social mobility, which is something very close to my heart, helping working class founders get access to capital, which I think is very important. We're also going to be looking at a PE type entity so that when our companies move towards their Series B and Series C, we have the firepower to still stay involved and utilize our preemption rights to them. And then we'll also be looking at direct raises. So where some other companies are deciding to give up the ghost, I think we're doubling down to say, we've done the hard yards, the thesis is working, we've got a good infrastructure in place, and we've got a good bunch of companies. And we're now not really investing in EIS companies. We're investing in companies that have the EIS badge, but we've got other institutional investors coming alongside us. So one of our companies, which will hopefully come to the US at some point, is a cashback app, which loads of people are doing. But this one, because the technologies came from Goldman, has managed to track your mortgage through the capital markets. So as you're collecting your cash back through your daily shopping or whatnot, you can then apply that to the capital on your mortgage. And through their numbers, you can save about 3 years of mortgage interest payments.
Wow.
So it's hopefully we can help out those companies, but as they move towards their Series B, because they've already got quite large partners like Ascension on board, Channel 4, which is one of the key broadcasters over here, has done a $3 million ads for equity deal with them as well. We can then stay involved once we've got that firepower from our mini PE fund.
I'm just wondering why that's a strategic investment for Channel 4, but what do I know? Anybody else? Huh?
I've got a question about the Cash App.
Yeah. Oh, Alex, introduce yourself.
Hey, sorry I'm late and
Yeah.
I can't stay long, but my name's Alex. I'm a first-time founder. Unfortunately, my background is in finance and investment banking, not marketing, but we can't all be perfect. But my background is primarily in specialty finance, which is basically specialty lending, so non-bank lending. Think like factoring companies, asset-based lending, pre-export finance, a whole lot. Mostly working capital. And about a year ago, I thought, you know what? It's a great time of life to be a first-time founder, and founded a fintech company, which is based on the provision of AI software to that sector, to specialty lenders. So that's kind of what I've been busy with for the past year or so. We're about to launch next quarter. We're tying up a capital raise. And you know, other than that, I just love being on Bonnie's. You know, I think it's not held often enough, but you know, I was gonna say weekly.
Yeah, it's every other week. So what's your question? And you do still split your time between Miami and London, right?
I do. Although this week, and this is why I'm late, I'm on the West Coast. And, you know, when you're capital raising, you sometimes have to show up in person. But yeah, I'm half in London, half in Miami. So I love to meet up in person over coffee, and
100%.
So my question is this on the Cash App, and this ties into your model. If you can track that mortgage, and you're getting the cash back, would you ever think of giving that client or that customer the option of saying, rather than paying off my mortgage, why don't you invest it in this fund over here that perhaps has a 10 times, you know, kind of return profile, which is a lot better than paying off a mortgage?
That would be, so as a VC, we have, in the way that we invest, we have negative controls on the company. We can't tell the company what to do. But knowing the founders who are ex-PS, I'm sure that they're thinking about something along those lines.
I was thinking even from your perspective, you know, your fund could be one of the investment options, right?
Exactly. And we'd love that to be the case because we're always looking for more people to come and actually do business with us. But yeah, that's definitely something that could happen. And this is where sometimes as an investor, you have to understand your limits as well, which is the founder's job is to execute. And I often say when I'm coaching founders, I often start off the session by saying, take everything I say with a pinch of salt because I'm the shiny guy. I'll distract you. And there's a risk of that happening. But founders need to stay on target. So when we're on a board observation call or on a board call, we are very mindful about what we're saying to the founders because our job is not there to be an executive member of the board, but to be a non-executive member of the board. And so one of my extracurricular activities is in the UK as being a school governor, which is a bit like being on the PTA for a US school, but your name is on the arrows for decisions that get taken. You're actually working with the head of the school, treating them like a CEO and acting like a Ned. And so in that situation, we would potentially root the idea, but we wouldn't be able to enforce it upon that founder themselves. And again, as an investor, you can have a lot of ideas. One thing I have learned is ideas are two a penny out there. It's the execution that really matters more than anything else. And, you know, doing the whole kind of Kim Il-jong do this, where you haven't really thought about the second, third, fourth derivative consequence that's going to come of that action. Maybe that individual who's doing that job day in, day out has. Any more questions?
Someone had a hand up.
Yes,
Yeah.
I have a question. It's always interesting to listen to Dipen, and
Yes.
and actually, I work closely with a company that has a patented model of multi-touch attribution and basically rewarding different parties in a e-commerce or online transactions. And one of the areas that we keep talking about with, you know, the project colleagues is this incoming huge rates of unemployment, not just in the tech world, but everywhere, big layoffs and, you know, the need for secondary incomes, passive incomes, or for people to be able to generate something from home. So a lot of like emerging market countries or even regular countries are promoting, you know, e-commerce as part of like export income for a country as well. So how do you think about these areas, or like, is there a target that, you know, you support certain companies, or you're interested in this question, like how it can become a bit of a part of a solution instead of always becoming worried about tech and AI, how it can also be, you know, part of a solution for many people to earn interesting incomes.
If I understood the question correctly, it's like, should people take up side hustles and have other sources of income? And for that, I would say yes. The other thing I would say is educate yourself around what's happening. So I talk to a lot of people who talk about their AI solution. And then when I question them a bit on it, and I've done some advisory work for a couple of AI companies, but I am not by any stretch of the imagination an AI expert. They trip themselves over. They don't know what they're necessarily talking about. And when I talk to the smart people in my network, they're constantly learning and teaching themselves. But this is where sorry, a bit of a tangent. This is where I have an issue with Gen Z. AI has made a lot of people think that the Matrix instant mastery has now happened because AI is going to give them the tools. And I'm not sure if you guys saw the report. I think it's MIT that produced it, which is they measured brain activity for people that were using LLMs. And the more that you use an LLM, the weaker it makes your mind.
Wow, I'm not surprised. I missed that.
Actually, there was another research study done, and they found out, I mean, I like the hybrid models, don't get me wrong, but they found out actually analyst reports are getting better once they are in the office, and they found this especially more strongly in women potentially because they have more distraction at home, and also with younger people, because I mean, I know as a young banker, just watching, just listening to the senior bankers, even how they talk to a client, like their hand movement, even how they order tea. I know it sounds bizarre, but how you should be at ease is a great education, and you cannot just do it in your own room alone. And so that really helped the young people to be in the office. Once you master your trade, maybe that's another discussion, but so I
think
agree
that's
with
what it comes down to. So I was talking to a chartered tax advisor with 25 years experience, and he uses AI to do some of his work, but he still checks everything that he does. Whereas there are a lot of younger people around him. It's almost like taking steroids. Actually, the better example is a live example, a real example that I can give. About 15 years ago, I got fed up with my pot belly and went to see a cosmetic surgeon to say, can I have a six-pack and can I have the big biceps? And he was a friend of mine. And he said, look, Dipen, why are you doing this? I was like, more confidence and I'll feel more better. And he made a very real kind of observation, and it's something that other people have now said as well. But it's like, you're not going to get the confidence from having, a sculpted six-pack and the stick-on biceps. You're going to get the confidence from going to the gym every day and watching your diet and controlling what you eat and being healthier. That's where the confidence is naturally going to come from. And as you learn your craft, and I can say this because I've done my 20 years, but for someone new coming in, there are so many shortcuts now which are not going to help them in the long run. And as Zarian correctly pointed out, I don't want to go back and say I worked at Goldman Sachs again, but while I was there, I worked with some world-leading people. And when I was at blockchain, I worked directly under a Goldman partner, and seeing how that individual controlled the room without trying to control the room. That's
experience.
That's something you get through hard yards. I mean, to use an American sports term, Kobe Bryant would be at the gym before anyone else and would practice shots 10, 15, 20,000 times. There was no luck involved. There was just hard skill.
Yeah.
And on the topic of AI, we've got an entitled generation coming through who are focused only on mental health and toxic culture and this, that, and the other, where you can get cancelled for saying something that they disagree with. And now we're giving them super weapons in the form of AI. And does that mean that we're going to move towards an idiocracy of people that don't know what they're talking about acting like experts? And that, I think, really concerns me. In terms of AI and business and e-commerce, again, we've got a lot of people that have seen shiny and thought AI is going to solve all my problems. And we had a company here called Klarna, which was very open about the fact that it's going to fire a load of its people and replace them with AI. They're now rehiring a lot of people because the AI is not the panacea to all of your business's problems. It can certainly help them. And a very, very good, an old work colleague of mine, Daminda Jiawara, who is the head of technology research at Peel Hunt. If you can't connect with him on LinkedIn, I know he's selective, just follow him. He just says smart stuff all the time.
What's his name? I'm sorry.
Daminda Jiawara.
You might have
He's
to
head
spell
of
that.
technology research at Peel Hunt, a UK brokerage. But him and his team had picked up some data which looked at the implementation of Microsoft Excel and Lotus 123, if you remember those. I'm old enough to remember both of them. And then the bookkeeper. And as proliferation of Lotus 123 and Excel increased, the bookkeeper decreased, and the requirement for that bookkeeper decreased. But then you had the financial accountant coming through. And so I believe that there will be a dislocation with AI coming through. But a lot of people won't understand what that AI is and what the risks are of using that AI, because it's a black box. And until you can properly audit what's going into the algorithm and what it's going to come out with and where it's been trained and the data that it's been trained on and how it's going to reinforce its learning through RAG and through graphing technology in the background, and if that's going to work for what you're going to do, we're going to see a dislocation, but then I think we're going to see a rubber band swing effect back, but then we're going to see a further dislocation coming through. And at that point, it's on the individual to have the personal agency to upskill and train themselves with what they're doing.
We had a speaker a few months back who specialize in AI, and one of the things he said during his presentation, I think it was during this because I've heard him speak a few times, was that just because you can use AI to do something doesn't mean you should use AI to do something.
That's right. I remember he said that. Yep. In fact, I was just writing about AI again in last week's editorial. AI, specifically ChatGPT, is creating a lot of mental issues. I mean, serious mental issues.
And I see some of them getting worse. I talked to another founder that wanted to take a family member's photographs, everything that they'd ever done, and put it into an AI model. So when that family member passed, you didn't need to worry, they were still there to talk and advise you.
Yeah, but this is very popular. There's whole applications about this. And
Yeah,
I
and-
find it how at some point you need closure.
Yes,
you
you
cannot
do.
pretend that they live there. Imagine
Yes.
it's your little child. This mother, she can
Yes.
never let go. Like it's a bit weird. I don't know, but okay.
As someone who's lost a parent, I'd love to spend another day with my dad. Right?
Same here, but
He's gone.
yes.
He's gone, and that is the way of things that he should go before me.
Yes.
Now, as I have a son, I wish on him the pain that I feel of losing my father, because the opposite is something that I wouldn't be able to handle. But it's
Right.
the things when you raise people and they need to move on. And again, this comes down to founders thinking they've got great ideas and sometimes not willing to listen to what it means. Human beings have evolved over 65,000 years to lose people. And that's part of our mental growth and part of what our mental resilience should be towards. Another founder I talked to has got the solution to mobile phones and children and weaning children off cell phones. And his solution was this. It was a screen-based phone, but it had hardware controls that prevented children from accessing the internet. And my thought was, I mean, that's the most stupid idea I've got. Children just shouldn't have phones anyway, right? So
But
if
he's
you're
just thinking of sales. For example, people invented cigarettes, and at one point it's a very profitable and elastic business. I mean, I know it sounds cruel, but yes, I mean, it's you have a humane perception on business. Yeah.
I think
And both
sometimes we need to be. Sorry, I couldn't hear you.
He said both.
I said both are addictive.
Yeah.
So if you're trying to stop me from taking heroin, you give me marijuana as the gateway drug, just stop the phones. And I gave some very direct advice to that particular founder who is convinced that he is onto a absolute gold mine. He's going to become a unicorn. And the other question I asked was, what's going to stop Apple doing what you're doing, or Samsung? Well, we think our technology is going to be better. You think your technology is better than Apple and Samsung? Really? Are your hardcore cost, your unit economics going to work? You're going to be able to meet the rule of 40? It's sometimes I think, again, coming back to the whole startup side of things, founders need to take a really hard look at themselves and think, is this the right thing for me to do? Sorry, I jumped onto my hobby horse then, but it's one of those things that really annoys me.
No, that's fantastic.
I remember Bonnie mentioning Joe Milan before, and I think that still carries from this culture of VC that founders also think that the VC investors look for a certain type of hype and personality, so they try to play to that, kind of studying them, and now it's changing maybe, and there is that disconnect, like they don't know what to do to get the investment.
VCs and investors are just human.
Yes.
And they're looking to invest. So many moons ago, I was a stand-up comedian and I did a few club nights. I wasn't very good. I wasn't very funny. But one of the things I learned is no one goes to a comedy club not to laugh. They all go to laugh. So 75% of your work has been done for you. All you've got to do is go in there and be funny. And if you've got an opportunity with the investor, it's yours to lose now. Either you've gone to the wrong type of investor who doesn't invest in your area, well, more fool you, or you haven't prepared.
Oh, Ralph, did you want to introduce yourself? I know you got here late, right? Did you want to tell us what you're doing or what you're up to? And you're muted right now. Oh, I guess he's
Ralph is there.
okay. You know, I have a business partner I work with sometimes, and an investor introduced me to a young founder about almost 2 years ago. And he was talking, he just needed to raise a little bit of money. But he was telling me what he's doing. And she's like, not interested, you're not raising enough and blah, blah, blah. And she missed what he was doing. I mean, I understood what he was doing, what he was working on. And I was listening to the substance, not the number. And he's doing phenomenally well. So I wonder, what filters people use, or what their criteria are.
I think in that situation, get the investor to actually circle back with you and say, right, do you understand my product? And clear any misconceptions. It could also be that there was a conflicting product within their portfolio.
I know.
We've seen an amazing company, but we know that we've got another portfolio company that's going to be very upset if we invest in what's seen as a potential competitor to them. And is that the right thing to do for our current investors? Are we capping the market of one of our current businesses? So there are a multitude of issues in play when, as an investor, you're making a decision. And the other thing is, FOMO around VCs is a real issue, which is part of the reason why the VC model is broken. I went to a conference in Barcelona back in 22 when I was at blockchain.com, and I got approached by a VC who said, can we invest in your startup? And I said, I work for blockchain.com, we're not a startup. And he goes, but you must have a startup as well. Can we invest in it? And this is when cryptomania was at its absolute peak. And VCs wanted to write checks. And I don't think they were good VCs. That's the point. You've got a lot of people with a little bit of money making very stupid decisions, adding to the hype. And I think I'm glad that we're not necessarily seeing that in AI right now. People are asking more questions. And I've got an amazing AI startup. It's not startup, it's more of a scale up that, quite frankly, we won't invest in because we just don't understand the technology. But from what I've seen and what I, through my very basic level knowledge of AI, understand is that this could be an absolute game changer with a phenomenal founder with more than just a 6-week course in AI, but a hardcore PhD in hardcore AI. How am I going to help them, really? I can give them money, but it's going to be dumb money. And when you're taking money from an investor, you really want it to be smart money coming in.
I always encourage founders I work with to look for smart money. Some of them are just, they'll grab at anything. You don't want to do that. It's really not in your best interest in the long run.
I actually have a question. It's regarding the relative advantages of UK-based and US-based startups. Given the tax advantages in the UK, that creates, I think, a very good baseline for C-level activity. But then there are all these cultural and financial issues and access to large markets and all these things that work against the UK relative to the US, especially when it comes to Series A and B and public financing and so on. So the question would be, we're at about $1 million run rate and we're growing, but we're completely virtual. We could be anywhere in principle. We're a software company. So if you were in our shoes, like, where would you move your company, or would you keep it in the US?
We'd love you to come over here to the UK. And there are lots of incentives through the government to help with that. So I assist a friend of mine, a gentleman by the name of Alpesh Patel, who's often on the UK news, and his official title is UK government deal maker. And he would go out to find a company like you and entice you to come to the UK, incorporate here. You'd then be an EIS type company and be able to get investment. I think it depends on the nature of your business. The reason why we're an e-commerce VC is when you look at online activity and e-commerce activity in particular, it's the UK and South Korea where the consumer is really, really hardcore around buying online. So if you're going to test out an e-commerce platform, the UK is a great place to do it because you've got a massive marketplace of people that transact online, which is why our high streets are dead and our malls are completely gutted. But UK consumers love buying stuff on their phones and buying it online. And so for online businesses, if you can get it to work in the UK in a highly saturated, very competitive marketplace, then you've got a good chance of getting it to work in the US. But let's face it, the US sets the tone, right? The US is the world's largest capital market, and it's one of the largest consumer markets out there. But the US is an incredibly difficult market to penetrate because the US is not one market. You've got 50 plus states. You've got different cultural nuances throughout all those states. You've got logistical challenges if you're delivering any form of hardware. And the US has got a lot of really smart people in it. And the arbitrage that you get from having a good business idea to when it's essentially copied and made better by a competitor out there is, the time on that is very, very slow. With AI native businesses coming through and the idea of a 10-person decacorn, a 10-person unicorn, and then decacorn coming through, I think that is going to happen sooner rather than later. And when the vibe coders who know what they're doing can piece together software very, very quickly, I think the competitive advantage is then lost. So I think that is part of the ups and the downs in terms of the investment size and investors. US investors are significantly more sophisticated and have significantly more firepower than European. I'm not talking down European and UK, but if I was in my company and we were looking to do a Series B, we'd probably want to talk to some proper hombres out in the US who could be seriously smart money. But then the downside of it is that we would then just be a number. Would there be the nice touchy-feely elements? I talked to my boss and he wants to increase the valuation of a company just slightly so that the entrepreneur has got a bit of a reward for having a profitable business. I don't know if we'd necessarily get that with a VC, or would their intention be, we need to increase the valuation because we need to make this look better on the books.
Got it.
But there are UK VCs that are bad actors and don't necessarily think that way. So I can't say that everyone in the UK is going to be fantastic and everyone in the US is going to be bad. I've talked to a number of US VCs and they're very, very good. And if you want to crack a market, go for the US.
Yeah. I was just reading this morning about a decacorn, a 6-month-old company, solo entrepreneur, just was acquired by Wix for 80 million.
That I don't understand. That I don't understand.
I don't either, but there you have it.
Yep.
Insanity. But maybe it's just the pendulum going one way. You know how the pendulum swings and then it takes a while for it to right itself.
Well, from what Sam Altman was saying about his staff being poached by Meta, being offered
I saw that.
Really?
And I don't.
Nvidia's got a problem now with some of its staff that have been there for a long time being paid in share options, being multimillionaires, and how do you incentivize them to now work when they could just kick it on the beach? Would I want to pay someone 100 million even if it was on a 5-year earnout?
No, I thought that was the signing bonus. That was my understanding that was the signing bonus.
But secondary is becoming very hot because of this. And there's a lot of people trying to do secondaries market, and the discussion if it becomes a bit liquid, because people don't want to go so IPO, and if it becomes like an active a bit market, then let's delay as much as possible and just the private markets are the new public markets. But then there's other talks that private markets are getting into all kinds of partnerships, KKR and Blackstones, etc., to try to enhance the retail investors into investing into illiquid assets. But another worry is they want to, because there's problem with the sector, is that do they want to offload to the retail investors? Do they want to exit and get the returns to their earlier investors, and it will be the retail investors who, pick it up later. I don't know.
Right.
I think that's a very big problem. Why would I want to buy something from someone who, if it's a great business, why aren't they holding on to it? That's the first question I'd ask. And if something's too good to be true, really it is.
It is.
And I think you need to think as an investor on that. And you're just looking at my theatre investments. Every time a producer says, this is an amazing show, it's going to do really well. yeah, that's the money that I flush down the toilet.
I guess that's your passion also. You don't
It
care.
stopped being passionate once it started becoming a 7-figure loss.
Yeah.
Cool. Are there any other questions?
Well, yeah, Dipen, I'm very interested in your investments in the entertainment sector. So you mentioned that you've had one big success on in the West End, but most of the other ones have not panned out. Is that right?
Yeah, I'm very happy to disclose that on 6 figures of investments over since 2013, I've made 23 basis points as a return.
Oh. And do you have any interest in investing in similar projects outside of the UK?
No, I don't think the market is sustainable. So when I looked at potentially investing on Broadway, number one, that puts me on Uncle Sam's radar in terms of the IRS, and that's a big no for me. Broadway costs are also exorbitant, just crazy. So a show that may cost $2.5 million to put on here in the UK, which is, and roughly the cost nowadays, is going to be about 7 to 8 on Broadway. But they'll still have the same runtime, but that differential in ticket prices is not there. Right. And so I'm aware of some very big Broadway productions with some very big names in them that haven't made money. And I've seen that here in the UK as well, where you can I invested in a play with Ian McKellen in it, Gandalf, right?
Yeah.
I made, what did I make on that? 4% was my return, and every ticket was sold. So I don't know what's going on. I'm talking to the producers about it. I've done children's entertainment shows, which are generally a good money spinner.
Yeah.
They've not done very well at all. And so I worry about the entertainment space because costs have gone through the roof.
Yes.
Cost has gone through the roof. So if your everyday individual can't go and see a show, if it's a live show, that's a very big problem. It's like Disneyland and Disney World. I mean, ticket prices there have gone so high, stratospherically high. How can your everyday person enjoy it? And then where do you build your client base from? Your returning clients. I went when I was a kid. Do I want to take my kid? Well, we can afford it, but do we want to spend that much money? Whereas I'm not saying that these should be public interest corporations or charities, but think about where you're going to get your next generation of customers through from a sector perspective. And I think that's where Broadway is going to have significant issues.
Yeah. But in some countries, there are state-sponsored theaters sometimes, especially for younger kids, and then there are others. And
we have an arts council in the UK, which hands out millions to support the cultural activities. But there are reasons for that, which is promoting the English language, not American English, promoting English soft power. And British soft power. So if you look at the actors in Game of Thrones, all of them came from British schools, and to keep that ecosystem alive. So when I talk to my friends, I've got a good friend who greenlights films for a major Hollywood studio. He prefers British actors and British technicians because there's a craft that you have to go through here. You have to go to drama school. You have to learn your Ibsen. You have to learn your Shakespeare. And his view is it's not that he's biased towards a British actor or a British technician. It's just that they save him money. They get it done in less takes, and they get the job done well. Will that last if the theatre system and the ecosystem isn't there? I don't know. And then what happens in the US? Because a number of exceptionally good American actors have come through Broadway and off Broadway and through the stage where they learn their craft. And I don't know what happens next. Are we just going to be in influencer world or AI created avatars that we're going to be watching on screen?
It's true. The Broadway ticket prices are out of control. I mean, I look at it, it's insane. And it's Sunday. I mean, it's summer. We have, the Philharmonic in the park. I live down the street from Lincoln Center. It's amazing culture. Just walk by the plaza. They have performances every night. But we're talking about the ABT. We're talking about top Philharmonic. It's fantastic.
But it should be accessible for everyone.
It's accessible for everyone. Just walk up there. They're there. They're performing. And they have a great, it's fantastic.
That's another focus of mine, so I'm going to get off that one now.
Okay, sorry. Any last questions? We have time.
Yes, how
Yes.
can we reach you? What are your
Yes,
I mean,
oh,
we are
yes.
connected on LinkedIn, but still.
LinkedIn. I'm the only Dipen Jobanputra on LinkedIn. So
Okay.
let me just put my details. Actually, let me find my LinkedIn.
Maybe an email as well. I don't know if you want to
Yeah.
send you something.
Yeah, I don't know. Do you have your email on LinkedIn? Some people don't. They don't put their email or their phone for some
I
reason.
generally prefer contact through LinkedIn.
Okay.
Mainly because now that I've jumped into this VC circus,
Right.
I'm being hit left, right, and center. But
And I
here's
knew,
my LinkedIn, and I'm very happy to connect with all of you.
and I knew that you and Zara knew each other from Diffuse.
Yeah,
Yes.
we've been in the final room at Diffuse on numerous occasions.
Yes.
Yes, yes. But this gave us opportunity to chat because, you know, Diffuse is like quick, you know, and
Yeah,
minute.
even the breakout rooms are just a few
Yes,
minutes.
yes.
So I want to thank you. We finally made this happen. Thank you.
Thank you. It's been a pleasure
Thanks.
speaking to you guys. If anyone would like to know more about Velocity, any of our portfolio companies, or just chat through what they're doing and just get a perspective,
Yes.
I'll be very happy to make some time.
Okay, and I'm going
Sure.
to introduce you to Joe Milam, the QSBS, and thank you for that. Thank you,
Thanks.
everybody.
Have a great
and we'll
day,
see
everyone.
you.